Inflation is spiraling. Interest rates are shifting. The stock market? On edge. Investors are losing billions, but a few are making a fortune. The real question: which side are you on? But here's the thing. While most investors panic, the smart money is already moving. So how do you protect yourself and even profit from this crisis? Stay with me, because in the next 10 minutes, I'll show you exactly what's happening, why it matters, and how you can stay ahead. Tech giants are taking a beating. Apple has dropped 15%, Tesla has plunged 20%, and Amazon has lost 18% of its value. Meanwhile, the Nasdaq is in free fall, and here's the unsettling reality. This might only be the beginning. If history has taught us anything, it's that inflation-driven crises follow a familiar pattern. During both the 2008 financial meltdown and the inflation crisis of the 1970s, surging prices forced central banks to aggressively hike interest rates. What followed was a wave of panic, triggering massive sell-offs and prolonged downturns. Right now, the market is mirroring those past crashes, and according to Goldman Sachs, the market could remain under pressure for at least another 6 months. This means we may not have hit the bottom yet, and if investors miscalculate, they could face even steeper losses. But here's the most critical point. Markets don't truly bottom out until a key signal appears. And as of now, that signal hasn't surfaced. So how do you know when it's time to buy? Stay with me, because that's exactly what we're about to uncover. While tech stocks are struggling, some industries are quietly raking in massive profits. The energy sector, for instance, is thriving as rising oil prices drive record-breaking earnings. ExxonMobil and Chevron have seen their profits soar, with ExxonMobil recently reporting an X% increase in quarterly earnings. Clear evidence that energy remains one of the most resilient sectors during inflationary periods. Meanwhile, consumer staples are proving their strength as people shift their spending habits. When inflation squeezes household budgets, consumers cut back on discretionary purchases and focus on necessities. That's why Walmart and Costco are outperforming many tech giants, because they sell what people need, not just what they want. And then there's finance and insurance, where Warren Buffett is making his biggest bets. He's pouring billions into these sectors, knowing that companies in this space have the power to raise prices and maintain strong profit margins even in times of economic uncertainty. The question is, if Buffett sees an opportunity here, should we be paying attention? While tech stocks continue their downward spiral, some industries are quietly thriving, seizing the moment as inflation reshapes market dynamics. The energy sector is one of the biggest winners. With oil and gas prices climbing, companies like ExxonMobil and Chevron are posting record-breaking profits. ExxonMobil recently reported an X% surge in quarterly earnings, a clear testament to the strength of this sector during inflationary times. When energy costs rise, these companies don't just absorb the hit, they pass it on to consumers, keeping their margins strong. But energy isn't the only industry capitalizing on inflation. Consumer staples are proving to be a safe haven as people rethink their spending. When the cost of living skyrockets, households don't stop buying essentials. They just become more selective. That's exactly why Walmart and Costco are outpacing many tech giants. These retailers sell what people need, not just what they want. Groceries, household goods, and basic necessities that remain in demand regardless of economic conditions. Meanwhile, Warren Buffett is making his biggest bets in finance and insurance. He's pouring billions into these sectors, and there's a good reason why. Insurance companies, for example, can adjust premiums to keep up with inflation, ensuring their profits remain stable. Banks, on the other hand, benefit from rising interest rates, increasing their lending margins and revenue. When someone like Buffett, one of the world's most successful investors, starts shifting capital into these areas, it raises an important question. Is he seeing something the average investor is missing? And more importantly, should we be following his lead? Most investors are clinging to outdated strategies, hoping the market will bounce back. But the ones who actually thrive in times of crisis, they're playing a completely different game. Instead of doubling down on struggling tech stocks, They're shifting their money into safer, more resilient sectors. Energy, consumer staples, and real estate have become safe havens. While the Nasdaq continues to slide, companies like ExxonMobil and Walmart are posting strong gains. Why? Because oil prices are soaring, and people will always need groceries and essential goods, regardless of economic conditions. But it doesn't stop there. The smart money isn't just moving capital around. They're actively protecting their portfolios. Instead of watching inflation eat away at their cash, they're hedging with real assets and inflation-resistant ETFs. Gold, oil, and commodity-based funds are outperforming the broader market, and it's no coincidence. When the value of cash erodes, tangible assets like these hold their worth. That's why investors are pouring money into SPDR Gold Trust, GLD, and iShares US Oil and Gas ETF, IEO, positioning themselves to ride out the storm. And then there's liquidity, one of the most overlooked but crucial aspects of navigating uncertain markets. The best investors aren't all in on stocks. They're keeping cash on hand, staying flexible, and looking for opportunities. They're also turning to alternative assets like Bitcoin. While it remains volatile, Bitcoin is increasingly seen as digital gold, a hedge against currency devaluation. Holding a mix of cash and crypto allows them to capitalize on undervalued opportunities when the market finally stabilizes. This is what separates those who survive from those who come out ahead. The question is, are you adapting fast enough? If you want to protect and grow your wealth in this volatile market, you need to take action now. The first step is reassessing your portfolio. Are you overexposed to tech stocks? If so, it might be time to rethink your strategy. Diversification is key, and that means shifting some of your capital into inflation-resistant assets like energy, commodities, and real estate. These sectors have historically performed well when inflation runs hot, and right now, they're proving to be some of the safest bets. Next, consider alternative investments. This isn't just about buying stocks anymore. ETFs that track commodities, gold, and oil have been outperforming traditional equities, and smart investors are taking notice. Crypto is another wild card. While it remains volatile, assets like Bitcoin are increasingly viewed as a hedge against currency devaluation, much like digital gold. The goal isn't to gamble, but to strategically allocate capital in ways that preserve its value as inflation continues to erode purchasing power. Finally, stay informed. The investors who come out on top aren't necessarily the ones with the most capital. They're the ones who adapt the fastest. Markets are shifting rapidly, and what worked last year may not work today. Those who keep up with economic trends, central bank policies, and market signals will be in the best position to make smart moves before the rest of the world catches on. The real question is, are you going to react when it's too late, or are you going to stay ahead of the game?